2017 didn't work out as some had expected. There were signs aplenty that equity indices would find the going tough, but none of it. Here we are, still with 5 trading days to go until the end of 2018, and the S&P has had close on 70 record closing highs. Ron William joins us now from RW Advisory. Well, he's a technical analyst, so we'll be looking at the charts in some more detail. Welcome. Now, let's just quickly recap, if we can, over the last 12 months. When we were talking here 12, 14 months ago, I think you were talking then about 2017 could potentially be a bit of a tough year technically for the S&P 500.
Well, certainly in price terms, it's been overbought for a long time, but the trend has been everyone's friend to date. It was more from a cycle perspective that we had a big 10-year cycle which had a negative period on average statistically during the year of the 7th year of each decade, and also the baby cycle, the seasonal cycle during the autumn months, which has on average been the strongest timing pressure for the market, where we've tended to see drawbacks in equity markets across the board. So this hasn't happened this year. Now there's two different scenarios here. Some are treating that as a very bullish signal, which in itself it is, when a market seems to be made out of Teflon and it just fires away despite any kind of risks, technical or other. The second thesis, which is probably more in line with what I'm thinking, is it doesn't mean that the risk has disappeared. And I think this is the word of caution that I'd like to warrant ahead of this new year. The risk is still there, and if anything, the cycle has now intensified that asymmetric nature, i.e. the more we continue higher without any kind of a sizable correction. Remember, volatility is at historic lows and has been for some time. The more that accentuates, makes the downside risk even stronger. So carry on with the long and hold strategies, but just be aware of the altitudes. Yeah, okay. Let's talk
about your most recent chart here. S&P 500 Fragility, you're saying, going into 2018. Explain what this chart is telling us.
Well, market fragility is the kind of theme, and that's very much kind of just illustrates the fact that the chart is still skating on thin ice, and so it doesn't take much to crack the ice. And right now, that crack is seen in both price and time measures. Price-wise, we are at an 8-year trend resistance level. So I repeat that, 8 years, so it's a pretty long-term pressure. We're actually testing above, we've just, I think, popped above that at current price value, just upon the latest price action. Even so, we're struggling at that level. Momentum studies are very overbought. We still need to see a rollover in that overbought condition to prove any kind of setback risk. But in addition to all of those price risks, we also have the time cycles there on panel B, just showing that there's this intermediate cycle which has worked before, and on average created a correction of up to 10 to 15% setback. That will likely time into the new year. And it's just another reason just to carry on watching the charts, carry on with the upside trajectories, potentially into 28, 20 and even higher if we break that level. But the key downside trigger is 2450, roughly around the long-term 200-day moving average. That would be the red alert signal for myself, and I would suggest for others too.
And where would that take you down, assuming that's triggered? Where then?
Well, where then it would more than likely be to the bottom of that channel. I think that would be a very normal and healthy correction.
So the Gann regression factor 3 times 1 would be your support point?
Yes, and I think for most classical chartists that would be a usual trend line, but it happens to coincide with the Gann regression line that I used there on the chart. And that would also take us back to I mean, that would negate a considerable part of the 2017, this year's gains. So a risk out there which would actually be quite healthy in line with previous corrections for the cycle that I've been testing at this moment, which should chime into the new year, but also just on average, volatility is at historic lows. It would be actually quite healthy to have a little bit of a pickup.
Okay, should just say these are weekly charts you're looking at here. Just quickly, in that case, going into the new year, are you happy to keep on following the trend?
Yes.
So you'll still be long?
In an existing and profitable long position, yes, but I would have very tight stops and be more on the risk-averse side, and so that's my suggestions to clients and traders out there. But the other side of this is if the index itself is starting not to behave the way that we feel is normal, it is worth looking at the stock level, because one of the main reasons for the market fragility is, of course, some of the internal elephants in the room, things like the FANG stocks, which have basically been holding the market up. So the Facebooks and the Apples of this world, the mega cap stocks. If we look at those just to see which one of those may falter, that would give also an interesting kind of top-down signal as to when this market might turn over.
Okay, this brings us on to the second chart, of course, Facebook, which you've brought along with you. Again, it's a weekly chart. This one is a bar chart showing us, well, similar sort of trend actually seen for the S&P 500. As you said, it's these sort of stocks that have been driving the gains really to some degree on the S&P 500.
Yes, and looking at this chart, I mean, much like most of the stocks within the FANG acronym, the Facebooks and the Apples of this world, it's been a one-line trajectory. I mean, the trend has really been a strong bulletproof trend up. But at the moment, what's interesting as well, not just the S&P index, which this is a big part of, but also the fact that we're at resistance on stock level on Facebook, on this multi-year resistance, roughly around 180 on Facebook. If we continue to hold above that level and break above 198, 200, 200 is a big psychological round number for a lot of traders, so that would be very bullish for Facebook, and then that would just be another bull signal. The concern is if we fail to break above 180, this long-term resistance level, part of the regression line that I've drawn in, and then confirm on the downside at 158. It's very important that the market tells us that it's breaking down as opposed to us just telling the market what to do, in my experience. So we need to fail at the resistance and then trigger the downside level at 158 to basically lead us to believe that there will be a wider correction. And what's important about the regression lines I've drawn, it also gives you an idea of magnitude in terms of the stage of the cycle that we're in, but also the price magnitude that can be expected. Now, early to mid stage of this regression, it's a small to medium-sized correction. But once we're at this kind of much more extreme end of the regression, it does suggest a larger mean reversion to the downside if and when that were to happen. The cycles pertaining to Facebook suggest that it will also likely happen into the new year. And also the momentum measures just there at panel
Yes,
B.
the bottom line is interesting because you draw a down arrow. The trigger there, what, 62 you're talking about?
Yes, so we're actually testing 62 as we speak. I checked it this morning just before the interview, and
right.
We're testing that level. RSI or momentum indicators in general are great for overbought oversold signals, but failing that, divergences and any range breakouts are equally, if not even more important. And this would be all of the above, and most importantly, below 62 would suggest that we've gone from a bull phase into a very strong bear phase. And important to keep in mind that Facebook is a big part, along with all the other FANG stocks, of these large indices that we're talking about.
That's new tech. Let's take a look at old tech, or some of the, in fact you brought along a chart here of IBM, which is an old Dow stock, despite the fact it's technology, but it's old tech.
Well, into this holiday season, it's nice to kind of speak about the blast from the past, and IBM's certainly one of them. It's part of the tech bubble, the IBMs and of the world back then. Interesting to make the point that as big as IBM is and as strong as a company it is, its price value has fallen down. And so this is when the price story breaks away from the fundamental story. And it's been in a downtrend since the peak of 2012. So maybe something that has been overlooked by some. We're trading back to where we were in the tech boom of Y2K. We are trading below the 200-day moving average. And so on one level, this is telling us how things can fade with time, old versus new, even big companies like IBM. But on the other side, this is also looking like an interesting short trade, just on a single stock basis, if we continue to trade below the 200-day moving average and ideally below the Y2K peak at 140, which ties into the probability distribution price indicator on the left there. The key levels on the downside would be the 2015 low at 110, 117. And then below that into 75.85. That would be a risk if we break below 110, 117 into then 75.85. And at the moment, the cycle, the momentum cycle, is also bearish.
On the point that this is a monthly chart, I mean, you're putting a stop above the last point, the last 182 would be far too far away, wouldn't it? Where would you put your stop if you were to go short on this? A lot closer, obviously.
A lot closer. I mean, it could be at previous swing highs. This is a monthly chart, so it's difficult to see that.
Yeah, of course.
But on a daily or weekly, we could pick prior swing highs. 182 would be definitely a get-out level of a short trade, and an important area to reevaluate for the upside.
Yeah, fine. Okay, so going into 2018, interesting picture as we look at this, but thanks indeed for joining us. Ron William from RW Advisory with his look into 2018 using the S&P as a benchmark and taking a look at old and new tech.